welcome to another edition of Straight from the Fund Manager. I am part of the equity fund management team at Nippon Life Asset Management, and I manage the Nippon India Focused Equity Fund, which is the fund under discussion today. Before coming to the latest development, let me just give you a background of the overall contours of the fund and the strategy. This is a flexi-cap, concentrated and high conviction strategy. Being flexi-cap in terms of market capitalization, there are no restrictions, although we run the fund at between 55 to 75% large cap and 25 to 45% mid cap, depending on the valuations and wherever we find valuations reasonable across the market cap spectrum. That also means that there is a stable core of the fund in terms of large caps, and there are satellite positions in mid caps, which we believe could be scalable and could become future large caps. And being 30 stock, it's obviously a high concentration strategy. This high concentration can manifest itself in many ways. It could manifest itself in outsized positions in certain sectors. It could manifest itself in outsized positions in certain themes, or sometimes it could manifest itself in outsized positions in certain bottom-up stock ideas. We would tend to believe that at all points of time, it's a mix of or a combination of the three of the above that we discussed. So let's talk a bit about the philosophy and the investment style of the fund. The basic objective behind investments in this fund is to invest in companies where we see potential to create significant value over the medium term. That potential could be due to various reasons. It could be due to a sector or a company in temporary downturn and available at cheap valuations. It could be due to the high growth potential of the company or the sector, or it could be due to company investing in a new product or a new sector or a new technology that holds significant potential to create value. The point we are trying to make here is that we are not constrained by investment style in terms of growth, value, or gap. We believe that market at different points of time gives different opportunities, and we are ready to grab those opportunities at various points of time. Our only mantra is to look for opportunities where we see high probability of value creation over the medium term. That's the only investment philosophy or the guideline that we follow at all points of time. Now, let me talk a bit more about some peculiarities of this strategy. Given the concentrated nature of this fund, one of them is that most of the points of time, the fund does have a good representation of high conviction ideas of the entire research team. Since the benchmark has 500 companies, whereas the fund can't invest in more than 30 companies, it is not very benchmark centric. And the top 5-6 positions makes about 35 to 50% of the fund at all points of time. That also means that some themes which we are bullish on could form sizable part of the portfolio. As we mentioned earlier, we focus a lot on scalability of our investments, so that becomes an important part of the companies or the sectors we invest in. We believe that given the nature of Indian economy, financials, technology, consumer, manufacturing, some export-oriented sectors, those are some of the key areas that fit this scalability criteria. We also try and identify a technological edge within these sectors, because increasingly we are believing that technology plays a very important part in value creation, and companies with some sort of technology edge have a high probability of non-linear growth. Now, having given you a flavor of the nature of the fund, let me come to the current positioning of the fund and how we are thinking about markets at the current juncture. On the overall macro, we believe that there would be a lot more volatility and uncertainty around commodity prices, inflation trajectory, government finances, and global growth going forward. We believe a combination of rate hike cycles across most developed geographies, along with quantitative tightening, would keep equity valuations under check, and the probability of valuation re-rating for most markets from here looks low. Corporate earnings also might face some downward pressures because of this commodity inflation, especially in sectors where commodity is a big part of the input cost. Yeah, having said all this, we still believe that India is poised to deliver healthy earnings growth over the medium term because of post-COVID normalization, because of upcoming credit cycle recovery in the banking sector. There are some signs of capex recovery also starting to take place. Household consumption is doing quite well in India, particularly in the middle and upper middle class segment. And as I said earlier, commodity sectors are getting a fillip from high inflation across the board. Given this macro background, The fund is today relatively slightly skewed towards domestic sectors. We are overweight on sectors like banking, auto, capital goods, logistics, media, uh, and domestic consumption. Some segments in discretionary part of domestic consumption. Those are the sectors that we are overweight on, and we are relatively underweight on global sectors such as IT, pharma, energy, and most of the global facing companies. Uh, the reason behind that, we already discussed that we are more optimistic on the Indian consumption and Indian domestic facing sectors, whereas because of the upcoming rate hikes and the quantitative tightening, it seems like global growth would face some de-acceleration in the quarters going ahead. Also, as we discussed earlier, there are a few micro factors where India is quite well positioned. One of them is India is on a cusp of a new credit cycle where both growth and asset quality could surprise positively. Therefore, part of our current portfolio include large banks which continue to gain market share, where we believe asset quality could help hold up quite well, and where they have the technological edge and the capability to invest in new technology and handle emerging disruptions in the financial sectors. Companies which benefit from post-COVID normalization and opening up of the economy, those are also they also form a major part of our portfolio. To complement this, some plays in sectors like logistics, commercial vehicles, which again benefit from opening of domestic economy. Those are present in the portfolio. We have also increased our exposure to auto in the past few months. We believe because auto as a sector is going through some temporary challenges such as supply chain pressures, demand issues due to high cost of ownership, margin pressures due to commodity cost, and technology changes which are going across the sector. We believe some of these factors could disappear in the next few quarters, and because of these temporary disruptions, the sector is available at reasonable valuations today. Therefore, auto is one sector where we have increased our weightage quite substantially over the past few months. On the underweight side, we are cautious on sectors which we believe are either expensive today or where COVID gave a temporary demand fillip, and the normalization could actually work on the opposite side. These sectors include traditional IT, traditional pharma. As a principle, we generally try to stay away from companies where technological disruption can lead to question marks over terminal value and long-term growth, such as traditional media, commodity sectors, especially in the energy part of the commodity chain. But given that the temporary demand supply mismatch across the world, we have increased some weight in the energy sector as well. So overall, we believe fund is well positioned to take advantage of the recovering domestic economy while navigating the challenges that lie ahead in global growth. The core philosophy of the fund remains to invest in companies which are scalable all over the long term, which have some competitive moat and technological edge in their sectors, and try to generate wealth for investors with patient and long-term approach towards investing. I guess that's it from our side on this edition of Straight from the Fund Manager. We'll come back to you guys in a few months or the next quarter with the latest developments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.